A business can claim capital allowances on the acquisition of plant and machinery for business purpose and for subsequent use of plant and machinery. Now, plant and machinery includes car as well and any other thing that meets the definition of plant and machinery. But remember that land and building is not considered to be part of plant and machinery. So no capital allowance is available on the purchase of land and building. But sometimes it happens that plant and machinery will be an integral part of building. Then in that case, that plant and machinery, as although it's an integral part of building, and building is not considered as plant and machinery, but plant and machinery is considered now as eligible for capital allowances if it is an integral part of building. Integral part means, for example, such as heating system in a building, cooling system in a building, lifts, etc., etc. Now, let's discuss the types of capital allowances that a business can claim. Capital allowances can be classified into three types. Number one is AIA, that is annual investment allowance. Second one is WDA, that is the written down allowance. And the third one is the first year allowance, FYA. Now, when you can claim AIA or WDA or first year allowance, let's discuss it in detail. Whatever plant and machinery that we have purchased will be either part of the journal pool or a special pool item. For example, if you purchase a plant and machinery, then you have to decide that whether this plant and machinery is a part of journal pool item or a special pool item, because you will get the capital allowance on the pool item such as journal pool or special pool. Now, as far as the WDA is concerned, written down allowance is available on journal pool item as well as special pool item, and it's an annual allowance that is available at the rate of 18% per annum or 8% per annum as per the specification of the pool. So journal pool attracts 18% per annum written down allowance, and a special pool attracts only 8% per annum WDA. Now, as far as the AIA is concerned, AIA is available on the acquisition of plant and machinery. That means that whenever you acquire a new plant and machinery, the first 200,000 of that plant and machinery will be available as AIA. And after that, the remaining part of the value of the asset will attract the written down allowance on an annualized basis. And remember that this AIA limit of 200,000 is available for a 12-month period of account. That means if the period of account is less than 12 months, that is of short accounting period, and if period of account is more than 12 months, that is a long accounting period, then this 200,000 limit might be increased or might be decreased. For example, let's assume that there is a short accounting period and our accounting period is of 6 months. Then the AIA would be reduced accordingly. So now 200,000 into 6 by 12. So now the limit is 100,000 AIA. So that means in this short period, if we acquire any plant and machinery, so up to 100,000 you can claim AIA, and on the above value you can claim written down allowance on an annualized basis. As far as car is concerned, car is part of plant and machinery, but car is not eligible for AIA. For example, if you purchased a car during the tax year or in an accounting period, that car will attract capital allowance, but the first part of capital allowance, that is AIA, is not available for the acquisition and use of car. So what kind of capital allowances are available for car? So that depends on the car carbon dioxide emission rate, that is CO2. So as CO2 is concerned, we can classify car into three types. For example, if carbon dioxide emission rate of a car is 50 gram or less than that, then this car will attract a first year allowance. And first year allowance is 100% of the cost of the car. You can claim 100% of the amount as first year allowance. But if the car's CO2 is greater than 50 gram and up to 110 gram per kilometer, then this car would be part of journal pool item. And we have already discussed that in a journal pool item, we will get 18% WDA on a per annum basis. But if the CO2 is greater than 110 gram per kilometer, then now this car is considered as a high emission car. So the WDA will be available as an special pool item. And only 8% WDA is available on such kind of car. So the first case is of a low emission car. This is a low emission car. This is an standard emission car, and that one is a high emission car. Now let's calculate the capital allowances. So for example, assuming that a business has purchased a plant costing 2,50,000 and the accounting period is of 12 months. Now let's see this, assuming this plant is part of a journal pool item. So first of all, cost of plant is 2,50,000 and how much AIA is available? First 200,000 of AIA is available. So we have claimed first 200,000 as AIA. The surplus amount will be part of the pool, either as journal pool item or as a special pool item, depending on the nature of the asset. Now on this surplus amount 50,000, we will claim a written down allowance of 18%. So the 18% figure would be 9,000 and the allowance would be of 9,000 and the carried forward value of the journal pool, that is tax written down value, closing balance is now 41,000 and the total allowance for this particular year is 209,000. Now this 209,000 is the capital allowance for this tax year that we will deduct from our accounting profit in order to find out the tax adjusted trading profit. And this 209,000 comprises of the AIA of 200,000 and 9,000 of WDA. Now let's take an example. assuming the text written down value brought forward of the journal pool is 41,000. Now we have few addition in the text here. Number one, we have acquired a plant having a cost of 2,80,000. Similarly, a car having CO2 of 80 gram per kilometer costing 50,000. What you have to find out, you have to calculate capital allowances on these assets. Now, let's solve this question. First of all, there is a journal pool column plus a column related to allowance. Now we have TWDV brought forward, that is 41,000. And now we have an addition that is qualify for AIA. So first of all, addition that is eligible for AIA. So that plant cost is 2,80,000 and our AIA is available 200,000. So I have posted this 200,000 into allowance section. And the remaining value is now 80,000 surplus, and that surplus is part of the pool. Now we have another car that we have purchased during that tax year at a cost of 50,000. And as the carbon dioxide is between 51 and 110 gram per kilometer, so it's a part of journal pool item. So car that is we have purchased, we can directly classify this car into a journal pool item. So after transferring these values, now we have total values of now let's calculate the value of the journal pool before the calculation of WDA. So we have the pool balance available, that is 41,000 plus 80,000 and plus 50,000. So the balance is 1,71,000. Now on this 1,71,000, as it's a journal pool balance, so the WDA is 18% per annum. Now we will calculate WDA on this amount. So 171 into 18%, and that is 30780, and this is the value of the allowance. Now the tax written down value carried forward would be 171,000 minus 30780, and now there is 140,220. And if you want to know the total capital allowance during this tax year, so this is 230,780. Let's discuss another example. For example, we have tax WDV brought forward of journal pool. Say suppose this is 85,000. Now we have certain additions during the year. We have purchased a plant costing 1,25,000. Similarly, we have purchased a car having CO2 of 40 gram per kilometer and its cost is 30,000. Another car we have purchased having CO2 of 120 gram per kilometer and its cost is 90,000. Calculate how much capital allowances are available. Now let's work out the pro forma for the calculation of the capital allowances. So we have journal pool, the special pool column, and the third one is the allowance column. So tax written down value brought forward is 85,000. Now we have addition that is qualify for AIA, and that is a plant having cost of 1,25,000. As you know that the limit of AIA is 200,000. So that means the full value is eligible for AIA, that is 1,25,000. So we are not able to utilize the full 200,000 value. Now there is no excess amount. So we have another addition, that is car having carbon dioxide rate of 40 gram per kilometer. So this car is eligible for first year allowance having cost of 30,000. So we can write it down. First year allowance, 100% value is eligible for first year allowance, and we have directly transferred this 30,000 into the allowance section. Now we have another car having CO2 of more than 110 gram per kilometer. So this car is a part of special pool item. So I have transferred 90,000 into special pool directly. Now we have a journal pool item of 85,000, a special pool item of 90,000. So we have to calculate the written down allowance on these two values. And we know that the written down allowance is 18% on the journal pool item. So that means 85,000 into 0.18, that is 15,300, and WDA of 8%, and that is 90,000 into 0.8, 7200. So we have transferred this 7200 as well, and now the PWDV carried forward. So the value is 85,000 minus this is 69,700. The other value is 82,800, and total allowance is now 1,25,000 AIA, 30,000 first year allowance, and 2 written down allowance. So that is 177,500 total allowance.